What if I told you that every hour you work is quietly being transformed into someone else's gold, without your consent, without a signature, and without a clear paper trail you'll ever see? You wake up, go to work, trade your time for money, and assume that money is a fair reflection of your effort. You assume it stores value. You assume it's neutral. But since 1971, something fundamental changed. Not loudly. Not with chaos in the streets. It happened behind closed doors, over a quiet weekend, with a single announcement most people didn't fully understand. Since then, your labor hasn't just paid bills. It has been converted, refined, alchemized. The real mystery isn't where the money has changed. It is how a system that once restrained power slowly evolved into a machine that turns human labor into banker. Escaled and why? It feels harder than ever to get ahead no matter how hard you work. To understand that, we have to rewind to a time when money was still tied to reality. For most of modern history, money was anchored to something tangible. Gold, silver, physical limits, even paper currency was only a claim on something real. This mattered because it imposed discipline. Governments couldn't spend endlessly. Banks couldn't lend infinitely. Every promise had a cost. After World War II, the world was exhausted and rebuilding. The United States emerged as a dominant economic power, and in 1944 global leaders gathered in Bretton Woods to design a new financial system. The agreement was simple. The US dollar would be backed by gold, and other currencies would be backed by the dollar. On the surface, it looked stable. Beneath it, pressure was building. The US began running persistent deficits. Wars were funded. Social programs expanded. Dollars flowed overseas faster than gold flowed back. Other nations quietly noticed that America was printing more claims than it could realistically honor. The system only worked as long as no one called the bluff. In August of 1971, the bluff was called, or more accurately, avoided. President Richard Nixon went on television and announced that the United States would suspend the convertibility of the dollar into gold. The gold window was closed. Temporarily, he said. That temporary decision never ended. In that moment, money was severed from physical constraint. For the first time in history, the global financial system ran entirely on belief. Fiat currency became the standard. Money could now be created without limit, constrained only by confidence. This was the birth of modern financial alchemy. Once money creation no longer required gold, banks gained extraordinary power. Credit could expand endlessly. Governments could fund deficits without immediate consequences. The cost of this freedom didn't disappear, it was simply redistributed. That cost became inflation. When new money is created, it doesn't arrive evenly. It enters through banks, financial institutions, governments, and asset markets first. Those closest to the source benefit before prices adjust. By the time money reaches workers, purchasing power has already eroded. This cause and effect loop became permanent. Credit cards became normal. Mortgages grew larger. Student loans exploded. Asset prices, stocks, real estate, bonds rose faster than wages ever could. Productivity soared, but compensation stagnated. Your labor still created value, but increasingly, that value flowed upward through interest payments, fees, rent, and inflation. The system didn't steal openly. It extracted quietly. Work harder. Borrow more. Stay afloat. This wasn't a conspiracy. It was a structure. Then cracks began to show. In the late 1990s, speculative excess fueled the dot-com bubble. When it burst, the response was easier credits. In the early 2000s, housing became the next engine. Debt was repackaged, sold, leveraged, and praised as innovation. In 2008, the illusion collapsed. Banks had created so much abstract wealth that when confidence broke, the system nearly imploded. Homes were foreclosed, jobs, savings evaporated. Millions paid the price. But something else happened that revealed the truth. Trillions of dollars were created overnight to save financial institutions. Banks were rescued. Workers were not. This moment exposed the hierarchy. The system existed to preserve finance first, stability second, and labor last. And to stabilize it, even more money was created. Quantitative easing became policy. Zero interest rates became normal. Debt stopped being temporary and became structural. The result was predictable. Asset prices surged again. Inequality widened. Those who owned assets recovered quickly. Those who depended on wages fell further behind. This is the human cost of financial alchemy. Since 1971, worker productivity has increased dramatically. Technology made labor more efficient than ever before. Yet real wages barely moved. Housing prices multiplied. Education costs skyrocketed. Healthcare became unaffordable. Debt filled the gap between income and survival. The system didn't stop rewarding value creation. It simply redirected who captured it. Ownership mattered more than effort. Access mattered more than work. Governments attempted solutions: minimum wage increases, stimulus checks, loan pauses, emergency programs. Each provided short-term relief, while leaving the core mechanism untouched. Printing money to fix problems caused by money printing only deepened the cycle. Every fix postponed pain and amplified future instability. The alchemy continued. Today, the pattern is no longer subtle. Central banks openly admit they will print money in crises. National debts reach levels once considered impossible. Younger generations work longer hours, own fewer assets, and carry more debt than those before them. The data is startling. Asset prices have far outpaced wage growth. Homeownership among the young continues to decline. Household debt climbs while savings shrink. Even inflation is reframed as manageable, while quietly eroding purchasing power year after year. The mystery from the beginning now has an answer. The system isn't broken. It's doing exactly what it was redesigned to do. So what does this mean? First, money is not neutral. How it's created determines who benefits. Since 1971, creation has favored those closest to the source. Second, hard work alone is no longer enough. In a financialized economy, ownership and leverage matter more than labor. Third, inflation isn't just rising prices. It's a silent transfer of value from workers to asset holders. Here's the warning: a system that continuously extracts from labor to stabilize finance eventually runs out of trust. And trust, not currencies, the true foundation of any economy. The open question remains unanswered on purpose. If your labor is the raw material, who should control the alchemy? Understanding the system doesn't fix it, but it breaks the illusion. And once the illusion breaks, real choices become possible. If you want more deep dives into the hidden systems shaping your financial reality, like this video, subscribe to the channel, and share it with someone who still believes money is just money.